got all eyes on IT. You've got TCS as well as HCL Technologies reporting their numbers post-market as today. So let me first take it across to Anisha and revisit what the ET Now poll is penciling in. Okay, while we get Anisha ready with her poll, let me also welcome on board Ankur Rudra as well as Omkar Tanksale joining in on the show to tell me what they are expecting from the IT sector this time. Ankur, hi. First, if I could, bring out, get you on board, just wanted to understand, after that sour disappointment in Q4, up until now Q1, has anything changed on ground for the Indian IT sector?
Hi, good morning. Thank you for having me. So what we've seen is that the demand environment has worsened across the sector. We've seen a continuous weakness in demand, while in the March quarter it was a bit of a surprise and it came up in the end of the quarter. This time we've seen persistent weakness across the board, and we've seen persistent weakness in depression in discretionary spending across a range of areas, and seems to be a lot more in sectors such as financial services, in TMT, and in North American sectors. So I think that's something which has happened. Along with that, what we've also heard and seen is there's been a consistent feedback of uncertainty in the demand environment, thanks to the interest rate hikes that have been going on, thanks to the pace of inflation that has gone through. So we are increasingly hearing that enterprises are not very confident of enterprise spending right now, and there's an increasing preference for perhaps deferring spend or delaying spend, or maybe even to next year. So that is quite a stark change compared to last quarter, where there was some hope that things might revive in the second half. I think we are increasingly seeing those hopes may not really come to fruition.
Okay, fair point. Omkar, similar question to you really. Just wanted to understand whether the slowdown that we are seeing is discretionary in nature, or do you think it's more structural or cyclical, and thereby this underperformance across the IT sector?
No, definitely. I mean, it's a discretionary in nature. I believe the kind of uncertainties is still persist in the market, is tending the clients to this delay in the spendings on IT side, measure predominantly into the BFSI, high tech side. That has impacted majority of the revenue of this large cap IT services, which has a maximum revenue contribution on the side. So I believe that is the reason. I believe in H2 there might be we can see a bounce back coming on to the after some settling down of the economies, and some stop. I mean, the interest rate might be settled down, and this economy cycle might get revived. At least they start spending on IT side as well. So it's more of a temporary situation, I believe. It's more of a the persons are not. I mean, the companies are not engaging much in the newer contracts which are likely to be there. That is my opinion about the current scenario.
Point taken. Ankur, hi, this is Anish also joining in the conversation. Just wanted to get a sense from you about your report that you published yesterday on the ER&D segment. You're quite a bit of contrarian there as well, expecting a downside of almost 40-50% on the likes of Tata Elxsi, KPIT Tech. Don't you think the companies which are more focused towards the auto vertical at least should be a lot more shielded from the structural slowdown that you are anticipating? Ankur, the question is for you.
No, thank you for the question. We are, what we've said really is that we are increasingly seeing that in a range of industries focused on engineering and R&D services, the element of urgency that was there on the spend for the last 2 or 3 years, partly triggered by COVID, such as in industrial smart automation, smart factories, in IoT devices, in healthcare, in connected products. A lot of that urgency is now missing, and hence these spends are increasingly seen as discretionary. So a range of industries such as manufacturing, industrial, medical, are seeing that pressure. Autos is an exception, like you said. That is an area where there is a lot more urgency which persists, and companies and segments of companies focused on the auto verticals are not seeing the same level of depression, but it is persistent and very apparent in almost every other sector, including media, telecom, and other sectors such as that.
Let's talk about the differential of growth rates in the mid-cap versus large-cap, Ankur. Of course, mid-caps have been leading, and that's obviously the case. They have been reporting at least strong double-digit growth. Well, the large-cap ITs have been stuck between this 5 to 7% range, at least with respect to the FY24 expectations. Do you think the street is baking in a lot with respect to the mid-cap IT and the valuations need to correct more there?
I think what we have generally seen in our research is growth is definitely slowing down across the board. Whether it is mid-cap IT services companies, including sub-segments such as ER&D, or large-cap firms. Large-cap firms have, for example, slowed down from mid-teens over the last 2 or 3 years to mid-single digits. I think the expectations were mid to high single digits at the beginning of this year, and they are very quickly going down to low to mid-single digits. So increasingly, we think that among the large caps, growth might even be less than 5% for most of this year. Now, the growth may not be as low on the mid-cap side, where growth is slowing down from, let's call it, 15 to 25% for the last 2 years to something in the region of 10 to 15%, or maybe in some cases high single digits. However, the growth slowdown is common. Now, if you marry this with the valuations that mid-cap and large-cap firms have, multiples have corrected across both firms. And if one looks at ratios such as profit, price to earnings versus growth, or PEG ratios, what's interesting is that the PEG ratios are quite similar. The average for large cap firms is about 1.8 to 2. The average for mid cap firms also is around, especially if you include the engineering services, is still 1.8 to 2. So there doesn't seem to be a clear valuation arbitrage for mid cap versus large cap, to be honest. Both have seen valuation correction in line with the earnings expectation correction. Now, having said that, we continue to anticipate and expect earnings are at risk for both these categories of firms. So we think growth can lower for both in both of them, but I don't think there's a clear arbitrage between the two classes.
Okay. Wanted to get in your view then, Omkar, in specific when it comes to TCS, given that the expectation is that we could see pretty strong deal momentum this time around. And what we'll be closely watching out for as well is, the deal pipeline. What is it in specific that you're expecting from TCS on these two fronts? How are you looking at the overall weakness in discretionary spending as well impacting the numbers?
Yeah, I believe TCS is, the major monitorables from my perspective are the outlook of the new CEO and MD, and on the verticals like BFSI, high tech and the retail side, because that have impacted badly, and how the spending delays are cut, how the spending decisions are they are doing it from the from the client side, and the majority of the clients. The spending outlook going ahead on the verticals, because the majority of the verticals is majority of the remaining IT companies have followed the same suit. So we'll get an outlook from that also. The deal wins we are expecting at around 7 to 9 billion, aided mainly because of the BSNL deal that they have cracked, and also on the deal side, the robust. We are still deal pipeline being robust. We do not expect in next quarter the TCS to have a strong bounce back. We may expect some settling down of the of the revenue side or the client side, but still spending delays will likely to be there even for the next couple of quarters. So the outlook remain a strong power point for the monitorable things.
Ankur, just wanted to come back with respect to the overall IT sector in India. What do you think the potential is with respect to generative AI? This morning itself, Wipro made that big announcement that they are looking to invest majorly. Of course, TCS, Infosys and the AGMs as well were making strong cases towards the utility of generative AI. Do you see this as a potential opportunity or a bit of a threat that a lot of companies might be looking at insourcing or going to global players now?
I think this is a key debate point for the industry. I think generative AI will probably be a significant source of disruption. Whether it will be positive or negative for Indian IT companies and what pace remains to be seen. But we think this will obviously be a significant driver of technology spend, the way it is spent, and who gets allocation over the next decade, almost like cloud was over the last 10 years. Our perspective at the moment is that generative AI potentially could be more deflationary in the near to medium term, mainly because a lot of the more legacy services around application maintenance, application testing, perhaps even application development, a lot of these maintenance heavy services could see automation. And even if they do not see successful automation, they could at least impact pricing, where there could be price aggression on the back of that. There will be opportunities, of course. There will be opportunities to build this into enterprise estates, and eventually companies will come around to working with IT services partners. But we think that's probably more of a longer term opportunity. In the short term, there'll potentially be smaller proof of concept pilot projects which will not move the needle.
At least in the short term, it won't move the needle. But do you think this earnings season will move the needle, Ankur, by a whole lot? Are you expecting, let's say, more downgrades after this earnings season, or there's a potential for more upgrades? Which side of the lever are you betting on?
Sure. So look, we are underweight the entire IT services sector. We don't have a single neutral or overweight. And we have been negative for a while. And the reason we are negative is we think the demand environment remains very weak in the short to medium term. We think the likelihood of revenues disappointing is high, and we've I think seen the street bring its expectation down for the first quarter already. We think there is still further downside to be had in the second half. I think there is still an expectation that there'll be a growth recovery in the second half of this calendar or fiscal year, and increasingly our channel checks do not suggest that could happen. This other risk factor for fiscal 24, for just staying on that, is also on the margin side. We think companies do not have the operating levers because growth is going to be challenged. There could be pricing pressure, and there could be increasing costs in other places. So companies will not have the operating levers to deal with margins. So there's a decent chance that many of the larger companies might see margins not only flat but even declining this year, which could be a negative surprise. So I think that all of that can drive earnings risk significantly starting from this quarter. Even going forward into 25, 26, we think growth expectations remain high. We think we are in a period of mean reversion to long-term rates of growth, which is about 6 to 8% and not double digits. Because looking at double digits is looking at just the last 2 or 3 years. We don't think that's the right mirror. The right mirror is what's been the medium to long-term sector growth trajectory over the last 15 to 20 years. So we see several areas of potential downsides, and we haven't even gone to potential risks such as generative AI deflating spend into 25 and 26.
Fairly bearish there, a perma bear at that as far as the IT sector is concerned. Quite a contrarian call. Thank you so much, Ankur, for joining us and talking to us about the risks that you see at this point of time, and Ankur, you as well, and Omkar, you as well, for talking to us about the expectations from TCS as well as HCL Tech today. So that's the word coming in. This quarter might be okay, at least from TCS point of view. Deal win should be strong, but the big question is, are we returning to the long-term averages of single-digit growth for the IT companies, and is double-digit out of the way completely? But on that note, sipping a very short break.